Okay, in this one, we're going to talk about how to account for a bond redemption. What is a bond redemption? A bond redemption is when a company, let's just say they don't want to make those coupon payments anymore. They don't want to wait for the maturity date. They don't need this cash right now. We're just going to redeem all these. We're going to pay all of these investors who hold our bonds, and we're going to redeem them all. And the bond is effectively over. Okay, they're not going to make payments anymore. So they want to end a certain bond. And I'm going to show you how to account for that. So it's going to involve paying out cash, retiring the bond from the balance sheet, and recognizing a gain or loss for the difference between book value and the cash amount paid. Okay, so that's a short way to do it. And if that's enough for you, you can stop the video here, but let me go through an example with Nike. So here's the most recent footnote I could find from Nike. This is from their most recent 10K. It's the 10K covering the period ended May 31st, 2020, as you can see here. And this is the long-term debt footnote. And the bond issuance we've talked about before is this November 1st, 2046 bond. And this November 1st, 2046 bond matures November 1st, 2046. So that's when they're going to make their payment of the maturity value, which is $500 million. So they're going to make a $500 million payment at that date. Along the way, they're going to make semi-annual coupon payments in the amount of 3.38% times that $500 million face value. Okay, so those are the semi-annual coupon payments they'll make along the way. And by the way, this is an annual interest rate, coupon rate, and it's paid semi-annually. So you could actually cut that in half, and they're going to pay half of this amount every half year, so that they'll pay the full amount every year. Okay, so that's how the payments are going to work. Finally, the final two columns are the book value as of 2020 and 2019. So the book value kind of looks like it remained constant from 2019 to 2020. But if you saw the whole balance, you'd see that this book value actually is still working its way up towards face value of 500 million. So the book value of bonds amortize up towards face value over the term of the bond. And this bond was issued in 2017 and it matures in 2046. So it's a 30-year bond. And its original book value was 490 million. So it's got 30 years to make the book value has 30 years to make its way from 490 million up to 500 million. Okay, so it's slowly working its way up, amortizing its way up. And just as a reminder, the amortization each year is the difference between interest expense and the cash coupon payment. So the cash coupon payment, I just told you how to calculate it. It's the coupon rate times the face value. And the interest expense is the beginning of your book value times the effective interest rate. So you need the effective interest rate to calculate that. But anyway, here's the book value, 491 million. Okay, next we need, what's it going to cost to end this thing, okay? The book value is not the fair value. That's not what investors are willing to accept to sell you their bond. So what are investors willing to accept to sell you their bond? And for that, you really need some sort of a data provider on real-time market data. So one of the best places I've used is my E-Trade account to kind of like find what bonds are trading at, but I didn't have data going this far back in time to May 31st, 2020. So I just Googled it and I found it on investing.com. Here's the Nike bond, maturity date of November 1st, 2046. Right now it's trading at 111.359. But on June 4th, 2020, which was just 4 days after May 31st, 2020, it was trading at 108.543. What does that number mean, 108.543? Well, it's relative to $100 of face value. So this bond is an aggregate of $500 million of face value. But for every $100 of face value, how much does it cost to buy this bond on June 4th, 2020? It costs 108.543. So let me just do this calculation then. If you take the $500 million face value, aggregate face value, and you multiply it by 108.543 over 100, so that's 1.08543, you'll get 543 million. So what would it cost Nike to buy its bonds at fair market value from everybody holding the bonds? Well, it would cost 543 million to do that, because this bond is trading at an 8% premium to its face value. So we need to pay 8% higher than face value to redeem this bond, 543 million. Okay, great. Now so anyway, that's the fair value at June 4th, 2020, okay? So let's talk about the journal entry. So what would the journal entry be? The journal entry, first of all, on June 4th, 2020, and we're just going to assume the book value is still at 491 million. It would really be a minuscule amount of change in book value over those 4 days. So the first part of the journal entry is going to be a credit to cash of 543 million. That's what it's going to cost. That's going to be a cash outflow from Nike. And that's what it's going to cost for all the investors out there who are willing to accept fair market value to hand over their bonds to Nike. So that's the aggregate amount it would cost Nike to redeem that bond, 543 million. These are all in millions. And what would Nike get in return for that cash? Well, they'd get to take that obligation off of their balance sheet, okay? They'd no longer have that obligation. And that obligation has a book value, a net book value, same thing, book value and net book value, of $491 million. So they can remove that obligation from their balance sheet. And for accounting purposes, the amount of cash they're having to pay off a relatively small book value, that just happens to be an accounting loss, a loss for accounting purposes. And so the difference between these two numbers shows up on the balance sheet as either a gain or a loss, depending on what the difference between the book value and the amount of fair value is. And this would be a loss on the income statement of $52 million. Okay, so that would be the accounting entry. Now, is this an economic loss? No, this is not an economic loss. You wouldn't advise Nike not to do it. Hey, you know, you're going to lose $52 million if you do this. That's not true. Nike is essentially buying an asset. They're buying their own bonds, and they're buying it for a fair market value. And so this is not an economic loss. And think of it another way. Suppose Nike had a different strategy to essentially end this bond. And what they were going to do is go buy some other company's bond, some very similar company. And this company's bond that they're buying has the same remaining terms. So the company's bond has a $500 principal payment in November 1st, 2046. And the company's bond has a 3.38% semi-annual coupon payments, okay? So some other company, similar company, has a similar bond. And it's trading at the same amount. It's also trading at $108 for every $100 of face value. What could Nike do? They could go buy that company's bond. They could go buy that company's bond. They would pay $543 million to buy it. And they would use the money proceeds from the coupon payments and maturity payments of that bond to just transfer those payments to its own bondholders, okay? And what would that transaction be? Well, that would simply just be Nike buying an asset for its fair market value. So this is not a what I'm trying to say, and then I'll stop, is this is not an economic loss, okay? This is an accounting loss because the book value doesn't perfectly capture the economic value, okay? Okay, great. By the way, why does the fair value differ from book value? Well, fair value is equal to book value at issuance. Okay, we learned that because the book value is the amount of proceeds a company gets for issuing the bond. So whatever investors are willing to pay is the amount of proceeds the company gets. They debit cash and credit debt. So at the inception of the bond, book value is equal to fair value. Then book value amortizes towards face value. So why does the fair value of a bond change after the issuance of the bond? And it's basically three different reasons. So either the company is becoming more or less risky than it was at issuance. So if a company is becoming more risky, the fair value of the bond is going to go down. It's like, why would I buy a bond from such a risky company? They're probably not going to be able to make their payments. So if they become more risky, the fair value goes down. If they become less risky, the fair value goes up. Like probably in the case of Nike, Nike's become less risky, so the fair value is high relative to book value. So the specific company might be more or less risky. Another possibility is that the interest rate in the market has changed. And so the federal government can affect interest rates by issuing debt or buying back its own debt. And so the underlying interest rate of borrowing money in the market could change. And that will have follow-on effects to bond asset prices, because bond interest rates are typically determined by using the federal funds rate And then plus usually some sort of a specific risk premium that bond issuance has over the federal government. The federal government is usually referred to as the risk-free rate. It's risk-free to borrow money from the federal government or to lend money to the federal government. It's risk-free because they can print money. So you're not really concerned about not receiving your coupon and maturity payments. So that's the risk-free rate. Companies are more risky because they can actually go bankrupt. And so there's usually a risk premium on companies' debt over and above the risk-free rate. Anyway, that's a long way of saying the fair market value can differ from the book value subsequent to a bond's issuance. And that's it. That's what I wanted to go through with you, is how a company would record a journal entry for the redemption of a bond. The answer is they credit cash for the amount it costs. They debit debt to remove the debt from their books. And they record a gain or a loss depending on the difference between the book value and the amount of cash it costs. Okay, that's it. So I'll talk to you next time. Bye-bye.